It is almost noon here in Tokyo. Welcome to Bloomberg Markets Asia. I'm Haidi Stroud-Watts. Here are your top stories. Asian tech shares slip as slowing US inflation sparks a rotation. While bolstering bets on Fed rate cuts, the yen swings as BOJ rate checks adds to speculation of an intervention. President Biden says he remains determined to seek re-election even as fresh verbal stumbles further heighten scrutiny of his campaign. Plus, we speak exclusively to the TCS CEO as quarterly sales and profit climb, signalling a recovery in corporate IT spending. But first off, let's check in on how markets are faring amid that rotation from high-flying tech and ship-related names. Avril Hong is in Singapore. Avril.
Yeah, Heidi, we're seeing that rotation away from that relative safety of the big tech trade, right? And those are the stocks that are really bearing the brunt of the selling in this part of the world, mirroring what we saw in Wall Street overnight. And this is against the backdrop, of course, of that US CPI print coming in soft and fueling those bets that we're going to see Fed rate cuts. Today, the Nikkei is leading declines 2.4% off, but the tech-rich gauges also, Kospi, TAIEX, we're seeing declines of upwards of 1% as well. For Japanese equities, might also be a bit of a knee-jerk reaction to the initial strength that we saw on the Japanese yen post-CPI print. Interesting, the Hang Seng is the outlier today, and we say that tech names are selling off, but the Chinese tech ones are actually doing quite well. Maybe a bit of expectation that we see supportive measures come the third plenum next week, maybe. But we are also keeping a really close eye on data from China on trade that's due later today. Now, we are seeing, of course, dollar yen now weakening past the 159 level. Let's put the board and take a closer look at the moves, because after the CPI print, it moved from 161.6 to around 157.5, and that sparked all this chatter about whether Japanese authorities actually intervene. For now, the top currency chief has been very coy, declining to say if they indeed stepped in, but we are seeing how the weakness is still coming through versus the greenback, the euro, the Aussie. So even if authorities did intervene, it didn't seem terribly effective. Let's flip the board, take a look at what we're seeing in how swaps market are pricing in the US CPI. Not only was it a softer print, a fall for a third straight month, it was also the first time it was negative since May 2020. So September hike, or cut, I should say, fully priced in, and two cuts for this year priced in by swap markets. Heidi.
Yeah, everyone, one of the things we're watching today, of course, are trade numbers out of China. We do have some of the yuan-denominated as well as dollar-denominated numbers coming through. Jan to June, imports in US dollar rising 2% year-on-year. Exports in US dollars rising 3.6% year-on-year. When it comes to that exports number, the expectation from economists surveyed was for 8%. That is quite a significant miss, and also a big decline from that 7.6% in the prior month. That May reading was 7.6%. We're also seeing that trade surplus coming in at 435 billion US dollars, or 3.09 trillion yuan there for the January to June period. So a big miss when it comes to those export numbers, and certainly not great timing given that they would have been hoping for a bit more of a stronger reading ahead of that third plenum kicking off on Monday. Avery will stay with us because we're going to get some more when it comes to where next for these markets. Our guest next is calling for 2 Fed rate cuts later this year. Let's bring in Gareth Nicholson, who's the CIO of Nomura International Wealth Management. Gareth, always great to have you with us. And, the expectations around the Fed are kind of settling, right? September is almost fully priced in. What risks are you looking out for at the moment? And I guess my biggest question is really, does that mean the exceptionalism when it comes to the US dollar is now starting to fade, or is that growth and yield gap going to persist and therefore continue to create this issue for Japan?
Yeah, focusing on Japan, I think that's key. Everett highlighted earlier on, did we see intervention? I think given the weakness we've seen over the last few weeks, given the level, given the velocity of the move, it is naive to think the BOJ was not ready, at least, to act if they needed to. Did they actually act? We're only going to find out at the end of the month. But the timing with the weaker CPI print, I think that was very positive for the BOJ in the sense that really took some of the heat out of it. We know a lot of fast money looks at that interest rate differential when it comes to US versus the BOJ rates, and that, I think, was one of the biggest drivers. And maybe that's also a reason why we're seeing, after the big move down to 157, they're coming back up. I expect it to remain around this level and range bound for some time. There's enough support for the US. There is also still uncertainty around what the BOJ is going to do. But generally speaking, stability will be good for the markets, good for the Japanese equities.
I wanted to get your views on these China numbers, and certainly a disappointment on the trade pulse, right? Even Bloomberg Economics was expecting that exports likely picked up in June, and there was also that flattering year-ago base as well. Even that didn't really help. Does this give you greater concern over China, particularly as investor expectations going into the third plenum seem almost non-existent?
Well, unfortunately, we have not been that constructive, and no one wants to be less constructive on an economy, but we have not been constructive on the Chinese economy for some time with regards to the pace of growth. We expect a lower GDP than what market consensus is. I think China has been focusing on export-led growth and not domestic. That's maybe been a bit difficult, but these numbers have just highlighted that it's not going to be a clear path to the recovery. China remains a tactical trade for us. We're obviously still invested in it, but there will be bumps along the road. And we don't actually expect a big monetary policy change or even incentives highlighted at this next meeting. Maybe at the end of the month, but definitely not this next meeting over the next few days.
Gareth, what do you think it's going to do with the currency, though? I mean, is it going to take this opportunity to kind of come through with a bit of a depreciation? Because it can do this without causing that much market stress if the dollar is weakening towards the end of the year.
Well, as you said, if the dollar is weakening, they could look to do that. If they're still focusing on export-led growth, then the weaker currency could support it. Our view is they need to use a number of levers to turn this around. They're really the sentiment within the US economy, the sentiment within the Chinese economy is just not there yet. You're not seeing locals buy the equity markets yet, and the foreigners are going to follow the locals. So we still think there is a fair amount of clarity to come before we're going to see a shift. So China remains tactical for us at the moment. We like certain sectors, but we're not moving the full load in.
Okay, it'll be closely watching what the Fed does. What sort of easing path do you think is going to be? Because is it going to be relatively shallow, or in 2025, how steep of rate cuts are you expecting?
From the Fed?
Yes.
Well, we've been pricing in 2 Fed cuts for a long time now. We've been non-consensus. We think it's come back to that. We expect 2 this year and 4 next year. We think that's going to be aligned with still a relatively strong economy. Yes, we're seeing cracks. We're seeing delinquency rates going up. You're seeing small business confidence diverging from big CEO business confidence. You're seeing the people on the ground struggling a little bit more. And that's the Fed is going to play into. But they're also conscious that the equity market, the other side, the exceptionalism, is still running very hot. So I think the Fed really has to 2 steps forward, 1 step back with regards to loosening policy.
Do you think that it's paying enough attention to what's happening in the jobs market? Are there dangers that it acts too slowly then?
There is dangers. And I think that's what we heard from Powell in the last meeting. He had tried to shift focus away from inflation is on the path that we're happy with. Inflation is kind of doing what we're expected to do. Now we need to shift towards labor. And I think we're going to hear more Fed speakers talk about that over the next few days as they start highlighting that unemployment rates moved up. Non-farm payrolls has been very noisy, but I think they are focusing a lot more on the labor now and making sure that's aligned. We're also going into a political year, and after September there will be quite a big gap before they can really do too much, given they don't want to be seen either way going into the politics. I mean, I think that's understandable. So whilst they're definitely independent, they don't want to be leaning. So it's going to be relatively quiet, we believe, between the September and the next rate cuts in December.
wanted to make a point of clarification when it comes to these numbers that we've really just gotten crossing the Bloomberg. We're still waiting for those June trade numbers from China. We did get that January to June number for both imports, exports, as well as the trade balance numbers as well. So that 8% estimate from economists is actually for the month of June. We're still waiting to see whether that's met or not. But certainly those numbers that we had were not for just June, but for January to June. And in fact, as I'm commenting on that now, the June exports number coming out in dollar terms rising 8.6%. And in fact, that is a pretty comforting beat, right? 8.6% year on year. The estimate was for 8%. I did mention earlier that is a flattering seasonal base that we're coming off as well. The trade surplus at just over $99 billion US dollars. The estimate was for just over $85 billion. The imports number in dollar terms actually seeing a contraction, 2.3% year on year. The estimate was for a gain of 2.5%. So clearly the domestic demand, the import side of things showing a bit more weakness. Imports in yuan terms coming in at a decline of 0.6%. The exports in yuan terms rising 10.7% year on year. So accounting for some of those currency fluctuations and the weaknesses that we've seen in the yuan, key is really that beat on that export number, 8.6% in June. So Gareth, that is a better picture for policymakers as we go into the key meetings next week, right? But do you kind of look at China? I know you haven't been constructive for a while. Is the expectation that this is kind of a new normal, that any policy move that we could get is really more about limiting further downside as opposed to the creation of any meaningful upside here?
Well, the big bang incentives, policy measures, we think that's not the game plan at the moment. It's more about stable, lots and lots of little supports. So the market has to come to that norm to then feel confident about it. The numbers, as you highlighted, I think is where they're focusing on the growth. It is about export-led growth. So that is moving in the right direction. We're very unlikely to hear any sort of additional big noise out of the next meeting. And I think if they can just slowly build that foundation, they hope to gain traction in the economy, and then the markets will follow. But this is likely to be a slow-moving piece and not a big bang bazooka effect that we've seen in the past from China.
Yeah, we'll see what we get out of the third plenum next week. Gareth, please stick around. Over to you for now, Heidi.
We'll continue that conversation and talk about some of the sort of broader geopolitical risks in a moment. But still ahead on Bloomberg Markets Asia, Morgan Stanley's chief India economist will be joining us to talk about their inflation outlook ahead of the June CPI print, plus our exclusive interview with the CEO of Tata Consultancy Services. A company reported a 9% jump in profit. Is this the start of a proper recovery when it comes to IT spending? This is Bloomberg. Get you a recap of the June trade data that we just got from China crossing the Bloomberg. When it comes to exports, that was actually quite a resounding beat year on year in dollar terms. We saw the June numbers coming in at 8.6%. That is better than expectations of 8%, and also seeing a bit of a pickup from 7.6%. Quite a meaningful one, actually. The weakness on the import side, though, pretty sustained, seeing a contraction of 2.3%. Estimates were for a gain of 2.5%, and certainly that worsens the import picture from 1.8% as well. So that really does leave that trade balance at just over $99 billion there. We have seen sort of early indicators of overseas demand, a bit mixed, but softer overall. So this is perhaps a little bit of a relief. Let's bring back Gareth Nicholson, who's the CIO of Nomura International Wealth Management. Gareth, thanks for sticking along with us. So if you take a look at the outlook for China, there's also, of course, the geopolitical overlay as well. And we're kind of getting into the point, the drumbeat towards November, whoever the Democratic candidate might be, it's pretty clear that policy on China will still remain pretty hawkish. Do you think that there's an additional overlay of risk there, or do you think these economies are kind of decorrelated enough that it is just a status quo?
I think when particularly equity markets are trading at the levels that we're seeing, the potential froth in there, a catalyst of uncertainty is something definitely to keep an eye on. uncertainty creates volatility, and that's what markets don't particularly like, especially when they, as I said, these levels. Now, when we're talking about political volatility and uncertainty, it started with the UK probably had the least amount of uncertainty, Labour landslide. You see them now focusing on the hard job they have to do. In Europe, more uncertainty. If you look at France, whilst they have a bit more clarity around where it's going, the actual parties, if you colour the different parts of the region of France by the different parties, it's like a Jackson Pollock painting. It is really scattered. There's going to be difficult to find consensus and get things done there. And then you move to the US. I think we're just starting to see the uncertainty and volatility come through. And this is really interesting because people have kind of moved away from what are these policies going to mean for geopolitics, for China, for Russia. I think there's still a lot to come in that space. And this is where watching how this evolves is going to be really interesting.
It has just been this alternate sort of clinging to Fed easing hopes, clinging to the AI story that's just rotated in this rally, right? Investors seem to be particularly good at just ignoring the geopolitical risk.
Well, yeah, and I think this is where it's going to be really interesting with this earnings season. At the moment, we haven't really decided, is this a true FOMO trade in US or a fundamental FOMO? The difference being FOMO, this has been driven by a lot of good news, demand, but this could have a serious pullback if people see a scare, maybe from geopolitics. Fundamental FOMO, if earnings come through and earnings are strong and beat it, then any pullback will be bought on. Any pullback will just be an opportunity to move up higher. These earnings, I think, are very important to see if we're going to break out of this high and move to a new high. So close eyes on it over the next few weeks.
We spent much of today really kind of fixated on the questions, still worrying over whether or not we're going to see President Biden seek re-election, right? In the case of a Trump presidency, do you think there are sort of tradable ideas around that? Are the markets prepared for this?
I think there's opportunities in both for markets. Markets are very dynamic. I think people are now shifting and spending a lot more time looking at what are the opportunities under a Trump government. I mean, the polls are suggesting this is the most likely. As I said, still a lot of uncertainty on the way. Higher taxes, potentially a higher debt. There is definitely going to be sectors that are going to be preferred. For us, the next stage is to, as I said, is this fundamental FOMO? Are the earnings strong enough to support these levels? They have been moving up. We actually think they will be. We think the investment relations from these big companies have communicated well enough. So we think there's going to be support. And then it becomes down to what could break this. And potentially it could be what's happening here. And if that's the case, then you need to look to diversify a little bit out of the US. Where is the next place to go?
And it's interesting because we've seen some of that international diversification going into obviously Japan, a bit more of a rotation into India, a bit more sort of back into Japan and back into China. But for the second half, where do you think the conviction flows are going to be?
Well, our highest conviction remains that the Japanese investor and the Indian investors still have money to spend. They still want to invest in their home buyers. And if the opportunity arises, if you have a sell-off, which, given the acceleration of both markets, that is not unlikely, but a sell-off we think will be supported. People will be buying the dip. We think that's an interesting place to potentially take some of the profit off from the tech and US exceptionalism and move it into there. But also, to be honest, the amount of money people have made on US equities, a small downturn is opportunity for many to get back in. This really needs to be a fundamental shift for this trend to change from where we are.
Going to take away the phrase fundamental FOMO from this conversation. Gareth, always great to chat with you. Gareth Nicholson of Nomura there. Much more ahead. This is Bloomberg. The leader of Samsung's largest labour union says their strike action is disrupting production. The union chief, Woo-mok, spoke to us about why workers have walked off the job.
It's been a long time since we've been negotiating, and it's been a year since 2023, and we haven't been able to sign a wage agreement. Despite that, and despite the fact that we've launched an indefinite general strike, the company seems to be thinking that they can win if they keep biding their time. We're going to continue with the general strike until the company comes forward.
Where could you find compromise to get to a resolution?
Since starting the wage negotiations, Samsung has never negotiated properly. We haven't been able to get a good negotiation in 2023 and 2024. So if we're going to get a deal this time, we basically need a pay raise for our members. We are not asking for many things. The company unilaterally announced 3% increase, but we are asking for a little higher, 3.5%. There is no transparency about the bonus pay system, so there are many complaints from employees there. So we are saying, let's improve the system with transparency. And for the most important, holiday rights, we're asking for 1 day for the union's establishment anniversary. So if we can get a resolution here, I think that's something we can agree on. And I don't think that we're asking for anything unreasonable.
Your union has targeted production disruptions, but Samsung says that they haven't seen any production disruptions so far. How will you achieve your goals then?
We're getting a lot of reports from the field. Like in the 8-inch manufacturing, a lot of current shift workers, people who work in manufacturing, a lot of them are on strike right now. So we don't have enough people to manufacture on that line. It's a manual line, so it's not automated. So that's where you need people, and they're taking a lot of people out of the office right now. And I know that they're not responding properly. And in another line, I'm hearing that there's a lot of equipment that's shutting down, but they don't have the manpower to handle it. So there's a lot of equipment that's going idle. And when you're producing semiconductor parts, obviously you have to do inspections and things like that. And there's a lot of that backlog right now. So there's definitely going to be quality issues.
We heard your union is getting advice from a former union leader at Hyundai. What sort of guidance are you getting from unions of other conglomerates in South Korea?
Oh, we're cooperating with other unions as well as Samsung-affiliated unions. And we're working with the Korean Metal Workers Union, which is where the Hyundai union is. We're getting a lot of help. And we're getting a lot of help from unions that have a lot of experience in this kind of thing. Because we're a new union, and we're leading this general strike with that help. We're going to continue to expand our solidarity with other organizations in the future.
Samsung workers usually get higher pay, also higher benefits than workers at smaller companies in Korea. Are you concerned that the rest of the country might not really sympathize with your demands, especially at a time when we know that Samsung semiconductor exports could actually help the broader Korean economy?
We're not worried about that. We're in a labor movement, and I think it's fair to say that we're fighting for the rights of all workers in Korea. Samsung Electronics is known as the best company in Korea. And if the wages are not raised properly, even at the best company, then the countless suppliers and small and medium-sized enterprises under them will not be able to get a proper wage increase. So if we raise the wages, then other companies will have a cascading effect. So Samsung Electronics is at the most important crossroads to raise the wages of the most important workers in Korea.
That was a National Samsung Electronics Union head, Son Woo-mok, there speaking to us from Seoul. In response, Samsung says it remains committed to engaging in good faith negotiations and is currently producing as planned. Taking a quick look at the China trade numbers, pretty good beat when it comes to the trade numbers, the export numbers side. On the import numbers side for June, we are seeing quite a bit of sustained weakness, in fact, a contraction of over 2%. That trade balance, so pretty significant in terms of one of the biggest trade balances surpluses since at least 1990. China's imports unexpectedly fell in June, leaving the highest trade surplus going back to at least 1990. China correspondent Min Lo joins us now from Hong Kong. So, Min, you know, that one sentence alone, pretty interesting timing as we head towards the US election, given how politically sensitive that trade surplus issue is.
We're seeing very surprising numbers coming out of the trade data today. That export really beating estimates by quite a wide margin, hitting 8.6%. That is the highest print we have seen in 15 months, going back all the way to March of last year. And imports, though, really missing the mark, collapsing negative 2.3%, really reflecting this very uneven economic recovery, that weak imports perhaps reflecting that very weak domestic demand, very lackluster demand despite all these policy stimulus that has come out over the past few months, and that export really surging now, perhaps reflecting that overall geopolitical environment, manufacturers really front-loading all the outbound shipments ahead of those impending tariffs. Remember, you have those EV tariffs from Europe kicking in in July, and you have those Biden's administration's new tariffs, the first batch of those kicking in August. So really, all these exports really surging in these couple of months ahead of those tariffs.
And then I've got more data due next Monday, just as, of course, the third plenum kicks off as well. The GDP number, what are we expecting?
Yeah, we have actually plenty of economic data coming out on Monday, including GDP, economic data, and then you have the home prices, the MLF rate, all of these coming out on Monday, just as these hundreds of Central Committee members gather in Beijing for that 4-day plenum. And there is a lot of pressure for them going forward because all those forecasts are pointing downwards. Growth likely to slow to 5% in the second quarter. Economic data generally pointing downwards as well, including that government fixed asset investment as well. So there's strong calls from economists now, just fresh from our Bloomberg survey of economists. They're calling for the government to really come up with strong policies, especially to rescue the property sector, to ramp up that May rescue plan and really pump in trillions more yuan into the economy, just up from that 300 billion yuan relending facility that we have seen so far. They're also calling for more policies to shore up China's tech self-sufficiency and also to address that heavy local government debt, because I mentioned that fixed asset investment is forecast to slow down, which perhaps reflects the limits that local government can really invest into the economy to lift growth going forward. And we know the central government has been pledging a proactive fiscal policy, but so far we are seeing government spending still lagging behind the budget deficit this year as it did last year as well. Monetary policy, you see the PBOC really tweaking and fine-tuning its policy toolbox, trying to halt that bond rally. That increase in yields could weigh on market sentiment and liquidity. And Morgan Stanley just came out with a note saying that there could be risk of currency devaluation in the months going forward. And as you said, that U.S. elections, lots of geopolitical risks really weighing on the economy going forward.
China correspondent Min Lo there, and Morgan Stanley just the latest on the investment front, weighing on the lack of expectation for major policy pivots, both from the third plenum and the following Politburo meeting getting started next week. But let's take a look at how, if we're seeing much of a market reaction, Ava, in terms of this set of trade numbers that we just got from China.
Yeah, it's interesting, right, Heidi, how that really highlights the concerns related to demand domestically in China. But it's not all that surprising. And today we're actually seeing the Chinese stocks, they're moving sideways. I mean, going into the lunch break with slight declines. But this is also a reversal from yesterday's performance, where we saw a lot of that knee-jerk reaction to tighter restrictions on short selling and quant trading strategies. Today, the Chinese tech stocks on the Hang Seng are actually the ones that are helping to lift the benchmark. Maybe going into next week, there is some expectation that we see near-term catalysts from the third plenum. Certainly, the property stocks listed in Hong Kong are among those that are gaining ground today. Now, let's take a closer look at what we're seeing on the yuan, because there was a reaction quite sharply. Take a look at how the offshore yuan fared in the aftermath of that soft US CPI print. It moved about 0.3%. This was its biggest move in about 2 2 months, I believe, a bit of giving up of the earlier gains now. But one of the things that we're also watching is whether the PBOC sees fit for there to be a bit of a controlled depreciation going into the end of the year. Maybe it utilizes the backdrop of the softer dollar to do so without causing much stress in the market. Of course, cheaper currency would be positive for exports growth, and this is something certainly we see as necessary given how the domestic picture is still weak. Let's flip the board and take a look at what we're seeing in some of the other Asia currencies, certainly that reprieve from a softer dollar initially, at least, dollar climbing a little now, but we're seeing the rupee among the currencies that are in focus ahead of that inflation data that is due for the month of June in India today, 83.54 on dollar rupee. Heidi.
Avril there in Singapore. Another data point that we're watching, India's June CPI data is due later today. Our next guest expects inflation to inch up just a tad. Let's get some more now from Upasana Chowdhury, who's the chief India economist at Morgan Stanley. It comes at a time where, of course, the inflation is still remaining above the RBI's target. And in fact, we heard from Governor Das saying that it's premature to even start talking about a significant pivot on policy. How long do you think it will take for inflation to return to more comfortable levels?
Yes, so the June CPI number that we'll get later today, we expect it to inch up to 4.9% from the last reading of 4.7. This is on the back of still elevated food prices, high-frequency food prices, especially, the more volatile component of vegetables, continues to remain, increase rather on a month-on-month basis. That trend usually happens in the summer months and with the onset of the rainfall season in India, and may continue into the months of July before settling down as the supply chain then normalizes. So I think the next few readings will have the impact of hardening on the monthly sequential basis because of this trend in food inflation. But at the same time, there is a favorable base effect from last year. So the YOY readings may not really edge up a lot, but could remain around this 5% handle. After that, so post-September is when we think that inflation in India, the CPI headline number, should settle more closer to 4.5. But we see it more sustainably remaining at 4.5 rather than going towards the 4% target that RBI has.
And in fact, we've seen the RBA staying on hold at 6.5% for over a year now. The previous meeting, interestingly, I thought we actually had two voting members of the RBA electing or voting for easing. Do we see, I guess, a risk to growth as now building now? So in our view, high-frequency data points and also the growth trend in terms of the drivers of growth remain pretty robust. We do see growth momentum remaining, at par, and our numbers are closer to 6.5 to 7% over the next 2 years. RBI is more optimistic at 7.2% currently. In our view, where we are in terms of policy setting, this is par for the course given the growth momentum remaining strong, upgrades to GDP growth on a faster than expected pace of increase in past data as well, and inflation still remaining above the 4% mark. So while macro stability as such remains in control, I think there will be, the growth outcomes will also be taken into account before discussing any change in stance or policy easing. So our view is that rates remain on hold for this year and next year, given the robust trend on growth, and therefore we don't really see that real rates have gone into restrictive territory as of now. Is the fiscal side with the budget upcoming likely to support the deflationary efforts?
So on the fiscal side, we think that, this budget that will come on 23rd July would probably be one in which you could see all elements in terms of fiscal consolidation. So in our view, the government retains now a number at 5.1% of GDP as per the interim budget. There is a risk that it could be marginally lower given the fiscal headroom that the government now has after the larger than expected transfer of surplus from the central bank. But that's not something that we are building into our base case. So with that sort of fiscal headroom, there's possibility of higher spending, but we think that will be more in the realms of capex and more targeted social welfare sector spending. So the mix of spending continues to be capex over revenue, and the consolidation path remains intact. So, in our view, if we get these numbers and this sort of spending mix, that would continue to support the disinflationary process.
From an economist's point of view, do you think the growth levels that we're seeing, perhaps the signals when it comes to corporate earnings, are enough to justify the return of enthusiasm for Indian equities?
So I think from an asset class perspective on the equity side, our strategist remains very optimistic. So both from the India market strategy absolute basis or from a relative EM basis as well, we are constructive on Indian equities. And I think it's not just, the near term or the cyclical story, which is pretty strong, but also the more medium term story where the economy is going to benefit from all the reforms that have taken place in the last few years, and some of it you're already seeing, which is helping to improve the competitiveness and also improve the earning cycle and therefore corporate profitability. So our view does remain on the strategy side as well, that there's more to go in terms of the earning cycle in India, and that will bode well for the equity asset class.
Aparna Chitra of Morgan Stanley, really great to have you with us. Still ahead on Bloomberg Markets Asia, our exclusive conversation with the CEO of Indian IT giant Tata Consultancy Services. We'll talk about what's next for the company across the sector after solid earnings in the first quarter. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching the India Focus. Take a look at how Indian markets are looking just ahead of the start of trading. We're looking like potentially a pickup of some positive sentiment after some weakness throughout the course of this week. Of course, some of the earnings uncertainty at play there, but looking quite positive, driven by these software companies. TCS's results, we get more on those in just a minute, beating analyst expectations. We're also expecting earnings out from HCL Tech a little bit later today as well. Eco is also on the agenda. Of course, factory output, retail inflation data coming out a little bit later today as well. Not much of that is expected to move the dial when it comes to any pivot from the Reserve Bank of India just yet. But of course, the big question is whether this earnings season is going to justify the big turnaround that we've seen in India stocks back into more bullish territory. Well, as I mentioned, Tata Consultancy Services, TCS, of course, the largest player in India's IT services industry. It has just reported profit that met analyst estimates, signalling that companies are slowly resuming spending on projects to take advantage of technologies such as AI. Net income in the quarter through June rising 9% from last year. Joining us now exclusively is the TCS CEO and Managing Director, K. Kritivasan. Kriti, really great to have you with us. And, this was a really encouraging set of numbers, and I know a lot of people will be hoping that the broader takeaway is that this is signalling kind of a more resilient recovery across IT services spending. In the call, though, you sounded like there were hints of caution when it comes to the demand side that you see.
Yes, there is, right? From overall demand environment perspective, I would like to still say cautious. It remains similar to what it was in the previous quarter. While there are areas where we see increased demand and interest, there are places where we are also seeing pullback coming from the customers. Customers continue to reevaluate the programs based on the return on investment and the period over which that return comes through. So I would remain cautious for maybe a couple of more quarters.
Is it a bit of a contradiction at that level of caution and yet expecting that this fiscal period to be better than the past?
Yeah, we are comparing with FY24. FY24, in our view, was much more difficult year. So there is an optimism on the long term, but we don't want to lower our guard. We still think that it's important to be cautious and stay very close to our clients and look at which are those areas of interest and spend from them and work along with them.
AI obviously is the buzzword for investors, for software services across the industry. How soon do you get to a point where some of these initiatives that you're working on begin to meaningfully impact revenue?
That I think will take some more time. We were discussing yesterday as well. Anytime a new technology comes in, the hype goes ahead of the reality, and we start expecting or overestimating the benefits in the short term and underestimate the impact in the long term. So it's a fairly new and young technology. Most of our customers are experimenting with it to see how it can bring a business value. It's a fascinating technology when you experiment with it, but it has to bring a business outcome to you. My view is we have to wait for at least one more year for this to become really mainstream to move the needle. But till then, you will see a lot of experimentation going on.
What kind of AI deals are you currently seeing in the market? What's sort of pricing dynamic like? And are some of these deals coming at the expense of other non-AI deals?
As I said, this is first of all not very material, right? Like from a overall revenue perspective, this is not significantly changing or increasing our revenue, though we are doing close to about 270 engagements today, and our pipeline is close to 1.5 billion, but it's still a very small number. So in that sense, it is not neither cannibalizing the work we do or significantly changing the pricing. But these deals do come at a better pricing because it's a new technology and everyone is trying out something new. But it is not going to change it significantly in the overall sense.
I'm curious if there's an explanation for why we're still seeing banks as well as tech firms in India holding back on spending when they're also operating at a time when Indian equities and stock prices are at all-time highs. Do you think that there should be a bit more confidence in incremental spending at this point?
Yeah, Heidi, actually, if you look at in India, the overall scene you see is more with respect to Western market. If you look at primarily India, we are doing quite okay. Yeah, we continue to see good momentum against in Indian banking sector. We don't see but you know our exposure to Indian banking sector in a overall scheme of things is much small. But otherwise, we do have a very strong growth momentum in India coming.
Does that mean if we're getting sort of firmer confidence about the Fed easing, that some of those US-based and perhaps international clients will be more willing to spend?
As I said, what happens in US is we need to wait for the elections. We need to wait for the Fed changing the interest rate. Those will be the appropriate triggers from a US market perspective. As I said, India operates on different set of parameters. Like definitely, Indian budget is coming up. What is in store in the Indian budget, and whether Indian interest rates change. Those are the things that we'll wait for and watch.
I'm glad you brought up the US election. What aspects of risk are you watching for here? Risk or opportunity?
See, before risk or opportunity, the first thing I believe is a certainty, right? Once a new administration comes in and they lay out their plan, there is a certainty for the next 4 years. I think the market is looking for whether whosoever wins, what the market is looking for some certainty for a medium to long term. I think when the new administration comes in, is what you get is a certainty. And I believe once there is a certainty for a medium to long term, there'll be more interest from our customers to spend or invest more. So that's the biggest advantage of till that elections happen, that certainty will not be there. I think that is the biggest value I see, whether I don't see any specific risk either way. But I think once the elections are over, it brings in certainty and people will continue to go along their plans.
India has some pretty lofty targets when it comes to chip manufacturing. We're also seeing competitors like Accenture really hone in on that opportunity through acquisitions. Is that something that TCS is focused on as well? Is that an opportunity that you want to be part of?
From TCS perspective, we will not be getting into the chip manufacturing, but what we see as an opportunity is to ability to work with the chip manufacturers in implementing their technology. Industry 4.0 is gaining a lot of traction. In the automation, in the manufacturing industrial sector is gaining a lot of traction. So that presents a huge opportunity for us.
Where do you see hiring going from here?
There are two aspects of our hiring. One is what we do from a college campus, and two is what we do from the lateral hire from the market. This quarter, we made, I think for the year, we have targeted close to about 40,000 hires from the schools. I think we are more or less on track on that. Like, we will calibrate it along every quarter based on how the demand situation is. But we are fairly confident it will be very similar to our normal years in the past.
And it's interesting because we have seen a slowdown when it comes to graduate hiring, not just with TCS, right? Do you think at this point there's maybe a fundamental mismatch between demand from IT services, the broader sector, and what we're seeing in terms of output from universities and colleges?
Well, this quarter again, we onboarded 11,000 freshers from the campus. So if you extrapolate, it is something like 40,000 for the year. So that has been our plan as well, to make offers to close to 40,000 associates during the year. But there is a seasonality also. There are some quarters you get more people coming out of campus, some quarters you don't get. But I believe we will stick to that number of 40,000. And whatever extra, if the demand peaks up, we'll probably go for more lateral hiring from the market.
Kriti, really great to have you with us. We appreciate your time. K. Kritivasan, who's a CEO and MD of Tata Consultancy Services. And of course, those numbers are creating a bit of optimism that perhaps this is the start of a sustained recovery across IT services. But we're also watching for HCL Tech. They're reporting earnings out a little bit later, trading higher by just about 0.5%. We'll see if TCS, of course, being the bellwether, reporting high profit, really is the start of a broader trend. That quarterly revenue performance for HCL Technologies, though, could trail those of their peers. We are seeing some of their clients being curtailed when it comes to spending on projects, according to analysts. $461 million for profit is the number that we're watching for. We're also on watch for bank earnings in the US. JP Morgan, Citigroup, Wells Fargo kicking off the result season from Wall Street's biggest lenders later. Much more ahead. This is Bloomberg. We are headed into the weekend, but some pretty big events that we're watching over the next couple of days. The youngest son of billionaire Mukesh Ambani will finally tie the knot with his fiancée on Friday. It has been months of celebrations, I believe 134 days. It's also telling Bloomberg that the wedding of Anand Ambani and Radhika Merchant will be attended by executives from the likes of HSBC, Samsung and Saudi Aramco. The guest list is also reported to include political heavyweights such as the former UK leaders Boris Johnson and Tony Blair, along with celebrities including David Beckham, Mike Tyson and Kim Kardashian. Meanwhile, it is also a big weekend for sports fans. Wimbledon's women's final on Saturday and the men's final taking place on Sunday. On the football field, we're also watching Argentina and Colombia facing off in the Copa America final. Spain and England will be clashing in Berlin for the Euro 2024 trophy. Let's get you to broader markets at the moment, and we are really kind of seeing a couple of things at play. One is digesting what it means, given that we had the weakness in the CPI numbers from the US and that pretty firm pricing of the September rate cut. Now, we're seeing the dollar, though, showing resilience. Dollar yen also sitting pretty firmly at that 159 level. This is Bloomberg.